Welcome to the Deep Dive. We are going straight into the heart of the latest earnings calls, giving you that high-level analysis and the critical nuance you need.
And today we're unpacking a really interesting one, Lindsay Corporation's Q1 Fiscal 2026 conference call.
Absolutely. This is a classic case of the headline numbers not telling the full story, right?
Oh, for sure. It was a brilliant quarter to analyze purely because of the paradox it presented. You had these messy reported numbers, especially on revenue.
Right.
But the market reaction was completely the opposite. Decisively positive. The stock just took off.
Exactly. I mean, an $11.8 million revenue miss isn't exactly a rounding error.
Yeah.
So our mission here is to unpack that tension for you.
Yeah, why did the stock jump from around 118 to over 126 in a single day?
It's because investors, they prioritize that clear, forward-looking project visibility over a temporary cyclical dip. That's the story here.
So let's quickly set the stage with those numbers. Total revenue came in at $155.8 million.
And as you said, that missed the consensus target of about $167.6 million, a 6% decline year over year. That's the messy part.
That's the miss. But here's the kicker. The GAAP diluted EPS, the bottom line, landed at $1.54.
Which actually beat the consensus of $1.53.
Just barely, but a beat is a beat.
So how resilient would their cost controls and their pricing have to be to absorb that kind of revenue shortfall and still deliver on the bottom line?
It speaks volumes about the quality of the management team. This wasn't just them slashing costs everywhere.
Right.
It was superb execution on pricing power and managing their input costs. They really defended their margins against those volume headwinds.
So investors saw the strong earnings quality plus the strategic wins we're about to talk about, and they just discounted the revenue miss.
They looked right past it. They focused instead on the full fiscal year commentary from CEO Randy Wood and the CFO.
Okay, so let's unpack this further because that total revenue number, it masks two completely different stories inside the business.
A tale of two segments, really.
On one side, you have the core business, the irrigation segment. That's where all the headwinds hit hardest. Revenues there dropped 9% year over year to $133.4 million.
That's the cyclical story, right. But then the growth engine was the infrastructure segment.
Completely different picture.
Completely. It delivered rock-solid performance. Revenues there were up 17% year over year to $22.4 million.
And that's all driven by things like municipal budgets, road construction activity.
Exactly. Road safety products. It just shows the diversification that's built into the company.
Okay, so diving back into that irrigation decline, which is what analysts were focused on, what was the why behind the weakness, especially in North America?
It's purely farmer sentiment. It's all macroeconomics. North American irrigation revenues were down 4%.
And management's description was what? Bouncing along the trough?
Bouncing along the trough. I think that's a perfect way to put it. The core problem is that farmers are delaying those big capital purchases.
So they're just fixing up old equipment instead of buying new stuff.
Exactly. Fixing old pivots rather than buying new ones.
And what's squeezing them? What's causing that sentiment issue?
Well, it's two things, really. First, you have ongoing trade uncertainty, and then you have the cost price crunch.
Okay.
So they're seeing low commodity prices for crops like corn and soybeans, but at the same time, they're facing really high input costs.
Like diesel, fertilizer, labor.
All of it. So their potential profit is just being eaten away, and that freezes their willingness to commit to a big multi-year spend like a new irrigation system.
We did hear some commentary about the administration's $12 billion farmer assistance package. I think it was $44 per acre for corn farmers.
Yeah, that came up.
Did management give any indication that this government support might spur some equipment demand?
Not really, no. Not significantly. While the financial help is obviously appreciated by the growers, management was pretty clear. They said that support doesn't translate into meaningful incremental demand for large capital equipment. At least not right now.
So the macro pressures are just too overwhelming at this point.
They are. The commodity prices, the input costs, it's just too much. So the caution is that these soft conditions in North America will probably persist for a bit.
And what about globally? Where was the international weakness?
International markets were volatile. We saw lower sales volumes in Brazil than they had anticipated.
And Brazil's a huge growth market for them, right?
It's crucial, but it's constrained by elevated interest rates and just a really difficult credit environment there. It makes financing these big farm investments really tough.
Okay, so here is where the narrative shifts. This is where it gets really interesting, and it's where the market found its enthusiasm.
Right.
If domestic irrigation is slow and Brazil is constrained, what gave investors that confidence?
It was the project pipeline, 100%, specifically that overseas visibility.
And this was the key strategic catalyst.
It was. Subsequent to the quarter end, so after these numbers, Lindsay announced a massive supply agreement valued at approximately $80 million in total revenue. And it's focused squarely on the Middle East and North Africa, the MENA region.
And the really crucial component here, the thing that gives investors that forward visibility, is that management reiterated their expectation for realizing about $70 million of that project revenue within fiscal year 2026.
That kind of multi-quarter certainty when your core market is choppy is invaluable.
It's absolute gold.
It is. Now let's talk about the economics of these mega projects because that's important.
Okay.
Management confirmed that, generally large project margins are slightly dilutive to the overall business average.
Meaning the gross margin percentage might be a little lower than, say, selling high margin replacement parts in the US?
Exactly.
So why do you pursue them so aggressively if they dilute the margin?
Because the strategic value is just massive, and they were quick to point out that the margin on this specific M&A project is, and I'm quoting here, as good as or better than the prior large project.
Okay, so this one's a good one.
It is. But the real payoff is what they call absorption and cadence. These deals keep the factory highly utilized, they absorb overhead, and they provide that revenue certainty. It buffers them from the volatility we just talked about.
And what's so fascinating here is the technology component. I mean, they're not just selling steel pivots anymore. They're selling a full solution.
Absolutely. Management highlighted that these huge ag operations are often starting from a blank slate.
Right, a greenfield project.
And so they require complete technological integration from day one. They're demanding the full suite immediately.
So that's the Zadig irrigation systems, the FieldNet remote management.
FieldNet, Field Advisor services, all of it. This mandate for maximum efficiency, especially with water and energy, it just reinforces this idea that Lindsay is providing critical precision technology, not just equipment.
That structural resilience, it's mirrored in the Q1 operational results too. Operating income was $19.6 million.
Yeah, maintaining an operating margin of 12.6%, which is consistent with a prior year. It just shows incredible operational discipline, even with lower revenue.
What about capital allocation? Where are they putting their cash?
They're being very aggressive for shareholders. They deployed $30.3 million into share repurchases during the quarter.
And that completely exhausted their prior authorization.
It did. And then immediately after, they signaled supreme confidence by announcing a new substantial share repurchase program of up to $150 million.
Wow. So they clearly see the current stock price as undervalued.
Very clearly. Undervalued relative to their future cash flow potential.
But they aren't just returning capital, they're also investing for the next cycle, right? While a lot of competitors are probably hunkering down.
That's a great point. They detailed two major CapEx investments focused on long-term efficiency.
What's the first one?
The first is the large 2-meter mill investment in Lindsay, Nebraska. This is where they manufacture the core steel tubing for the irrigation systems.
So a major upgrade to the heart of the operation.
A massive upgrade. They're integrating robotics, modern workflow systems. It's all designed to improve safety, decrease reliance on labor, and just significantly boost their throughput. And it's set to turn over to full production within 30 days.
So that's a very near-term optimization. What about the longer-term structural improvements?
That would be the complete re-engineering of their galvanizing facility. It's essential for ensuring the durability of their steel products.
Right.
This investment is about making that process safer, more efficient, and more environmentally friendly. And that's expected to kick off production around the end of calendar 2026.
So these are big long-term drivers.
Yeah.
But management was pretty cautious on the immediate margin impact.
They were very transparent about that. They said, in the short term, you'll see incremental depreciation from these new assets hit the P&L.
And that'll offset the productivity gains at these low demand levels.
Exactly. The margin improvements from that powerful operating leverage, that lower cost per unit, they'll only really materialize once North American demand picks up. And these facilities can run at higher utilization.
Okay, we need to pivot now to the other lumpy segment, infrastructure, and specifically the famous road zipper product.
Right.
That segment was strong in Q1, up 17%, but management gave a very clear forward-looking forecast warning.
A very specific warning, yes. One that analysts really need to bake into their models.
So what do they say?
They noted that while the sales funnel is robust, they do not see a large road zipper project exiting that funnel in fiscal year 2026.
Okay. And that creates a difficult comparison, specifically in Q2.
A very difficult comparison. In Q2 of last year, they shipped a substantial $20 million road zipper project.
A $20 million prior year comp in Q2 is a huge hurdle for that segment. Are analysts currently baking that in?
They should be, because the company's guidance was crystal clear. They expect smaller projects and growth in road safety products to offset about half of that $20 million hit in Q2.
Only half.
Only half, with the majority of the offset volumes from other project work not hitting the books until the second half of the fiscal year.
So it's purely a timing issue.
Purely timing, it's inherent to large government contracting. Management was very firm in their conviction that the total addressable market, the TAM for road zipper, is nowhere near capped.
Okay, so we've covered the core paradox.
Yeah.
Domestic weakness versus this huge international project strength. We've synthesized the operational resilience and the timing risks in infrastructure. And that precise transparency that management provided, outlining the Q2 dip followed by a Q3, Q4 acceleration, it really sets up a fascinating thesis for how investors might approach the next 6 to 9 months.
It sets up a very specific timing play.
So let's explore that. This is not financial advice segment. This segment presents an aggressive, high-conviction thesis based purely on the data points we just discussed.
The information on the call allows for a pretty unique, time-sensitive thesis here. The Q2 short Q3, Q4 long timing trade.
Okay, lay out the logic for the listeners. Why would you bet against them in Q2 only to turn around and get long later in the year?
Well, this trade is explicitly exploiting the company's own transparent guidance on their project cadence and their comps.
So the setup for the short leg is almost non-discretionary.
It is. The infrastructure segment faces that brutal, non-repeatable $20 million comparison in Q2.
Right.
And since management told us the offsetting volumes won't fully materialize until the second half, we would short Q2 earnings. You'd be betting on that temporary volume dip causing some market nervousness, maybe a short-term correction when those lower infrastructure numbers are reported.
So we exploit the dip that the company has basically telegraphed to us. Then how do we establish the long position?
Simultaneously, or maybe immediately after the Q2 report, you establish a long position. You're banking on the huge visibility and the revenue acceleration from that $70 million MENA project hitting the books in Q3 and Q4.
And that, coupled with the realization of those delayed infrastructure offset volumes.
Exactly. It creates a really powerful high conviction acceleration profile for the entire second half of fiscal 26.
So what's the biggest risk? What would completely negate this timing trade?
The primary risk is an unexpected macro improvement in North America. That's the one thing that could throw this off.
So if that irrigation segment, which is bouncing along the trough, suddenly improves faster than anyone anticipates.
Yeah, say due to a massive unexpected surge in commodity prices or a major resolution in trade certainty, that incremental domestic demand could easily smooth over the infrastructure segment's Q2 comp hurdle.
And that would eliminate the short-term dip that we're looking to exploit.
Completely.
So what does this all mean for you? Lindsay's Q1 print was really a story of operational excellence and future visibility. It proved that significant project wins and disciplined cost management can easily outweigh that cyclical North American weakness in the eyes of the market.
They are executing incredibly well on pricing and cost management, and they continue to deploy capital wisely through both repurchases and that efficiency-focused CapEx.
And the integration of that high-level technology FieldNet Field Advisor, it's now a non-negotiable part of these major international contracts.
And those contracts are fundamentally driven by global food security needs. It's a structural tailwind.
Which raises our final provocative thought for you to chew on. If these huge international contracts mandate the full tech suite right at installation, does that mean Lindsay's future revenue is less about the fickle North American farmer replacement cycle and more about securing these global, multi-million-dollar technology implementation contracts?
So should we view this company less as a cyclical equipment provider and more as a precision technology solutions business?
If that shift is structural, it changes the entire lens through which the company should be valued.
A completely different multiple.
Thank you for joining us on this deep dive. We appreciate you exploring this complex story with us.